If you are holding silver tonight, there is a number you need to know before Monday, and it is not the price. It is Friday, June 26th, 2026, and silver just closed somewhere in the high $50 range, a little above $58 a troy ounce on most spot trackers. That is a real number. It is also, in a strange way, the least useful number you will hear all weekend. Because the question that actually matters for your money is not where silver closed today. It is what you are going to do with that information before the Asian markets open again on Sunday night. So before we go any further, I want to ask you something. When you look at your silver position right now, which number is your brain locked onto? Is it the price you paid when you first bought in? Or is it the all-time high from January, the number that makes every day since feel like a loss? Sit with that for a second, because the answer to that question is probably driving more of your emotional state right now than the actual math of your portfolio. Here is where this gets interesting, because the story of silver in 2026 is not really a story about silver falling. It is a story about two very different markets, paper and physical, telling two very different stories at the same time. And almost nobody watching the headlines this weekend is paying attention to the gap between them. Let's start with where we actually are. Silver is trading in the high $50 zone, somewhere around $58 to $59 depending on the exact moment you check. Just 5 months ago, on January 29th, silver touched an all-time high near $121.60. That means, depending on the exact print you use, silver has given back somewhere around 50% of its peak value. Gold, in the same window, hit its own record high of $5,589 on January 28th, and has since pulled back to somewhere around $4,000. That is a correction of roughly 28 to 29% for gold. So gold lost about a third of its peak gain, silver lost about half. That gap, that difference in how hard each metal has been hit, is the single most important fact in this entire story, and we are going to come back to it. Now, why did this happen? The short version, the version every financial headline is giving you this week, goes something like this. The Federal Reserve, under its new chair Kevin Warsh, surprised markets with a hawkish dot plot in June. 9 of the 18 voting members are now projecting at least one more rate hike before the end of the year. The dollar index pushed above the 100 mark for the first time in about a year. Traders are now pricing somewhere around a 2/3 probability of a rate hike in September. Higher rates and a stronger dollar make non-yielding assets like gold and silver less attractive, so money rotated out. Add in continued outflows from silver ETFs, and you have the explanation for the headline. All of that is accurate, and none of it tells you what to actually do this weekend. So here's the real question nobody is asking out loud. If the paper price of silver is being driven almost entirely by interest rate expectations and dollar strength, what is happening underneath that price? In the part of the market most people never look at. This is where I want to slow down, because this next part is the part that, if you understand it, changes how you read every silver headline for the rest of this year. Back in January 2026, something happened in the physical silver market that most casual investors never even heard about. In a single 7-day stretch, roughly 33.5 million ounces of silver were physically pulled out of COMEX registered vaults. That is not a typo. 33 million ounces, gone from the deliverable pool in 1 week. That represented somewhere around a quarter of all registered inventory disappearing almost overnight. At the same time, silver lease rates, which is essentially the interest rate you pay to borrow physical metal, spiked to roughly 8%, a level that had rarely if ever been seen before. Some institutions that held paper claims on silver discovered, in real time, that producing the actual metal when delivery was demanded was suddenly a lot harder than anyone expected. That was 5 months ago. And here is the part that should make you pause. The COMEX coverage ratio, which measures how much of the total paper exposure in the silver market is actually backed by deliverable physical metal sitting in a vault, has not meaningfully recovered since then. As of the most recent data available, that ratio is still sitting somewhere in the low teens, in a zone that analysts who track this market generally consider stress territory. Some trackers put it closer to 13%. Others, using slightly different inputs, put it a bit higher, around 16%. Either way, it has not snapped back to comfortable levels. So you have a paper market that fell roughly 50% from its peak because of interest rate fears. And underneath it, you have a physical market where the deliverable supply cushion never actually rebuilt itself after January's stress event. Those two things do not have to agree with each other in the short term, and right now, they don't. Before we go further, I want to take a quick pause, because if this kind of breakdown, where we separate the noise from the structure, is useful to you, that is exactly what this channel is built around. If you want more of this kind of thinking applied to gold, silver, and the broader macro picture, subscribing genuinely helps. Not because the algorithm needs it, but because it means you will actually see the next one of these when the data shifts, instead of finding out 3 weeks late from a headline that has already moved on. Okay, let's get back into it, because the next part is where most silver holders are making a mistake without even realizing it. If you bought your silver position any time before roughly the middle of 2025, there is a good chance you are still sitting on a meaningful profit right now, even after this correction. Think about it this way. For most of 2024, silver traded in a range roughly between $28 and $32 an ounce. If your entry point was somewhere in that zone, then even at today's price in the high $50 range, you are still up somewhere between 80 and 100% on that position. That is not a loss. That is a position that ran up hard, gave back a chunk of its gain, and is still sitting well above where you started. This is not a new pattern either. If you go back to 2010 and 2011, silver ran from around $18 an ounce up to nearly $50, and then corrected down to around $26, a drawdown of close to half from the peak. Investors who were anchored to that $49 high felt like they had lost almost half their money. Investors who were anchored to their original $18 entry recognized that $26 was still a gain of more than 40%. Same price, same market. Completely different emotional experience depending entirely on which number you were measuring against. So here is the first thing worth doing this weekend, and it costs you nothing but 5 minutes. Write down your actual entry price. Not the peak, not what a YouTube video told you to feel, your actual cost basis. Calculate your actual return at today's price. If you bought near the top in late 2025 or January 2026, somewhere in that $90 to $120 zone, your situation is genuinely different, and we will come back to that specifically in a few minutes. But if you are like a lot of long-term holders who built a position over 2023, 2024, or early 2025, this correction may feel a lot worse on a headline chart than it actually is on your personal account statement. Now here's where the story takes a turn that most people watching this weekend have not even considered. Not all silver is the same silver, and in a market where we have already seen one physical delivery scare this year, that distinction is not academic. It is the difference between owning something with no counterparty at all and owning a claim on someone else's promise. If you hold physical coins or bars in your own possession, in a safe or a vault you control, there is no counterparty between you and the metal. You own it, period. If you hold something like the Sprott Physical Silver Trust, which trades under the ticker PSLV, you own units in a trust that holds allocated, audited silver in a vault. And as a unit holder, you generally have the right to redeem for physical bars if you meet the minimum size requirement. That is a counterparty, but it is a specific, audited one with a defined redemption mechanism. And if you hold shares of a fund like the iShares Silver Trust, ticker SLV, or a similar cash-settled product, you have exposure to the silver price, but you typically do not have an individual right to demand physical delivery of a specific bar. Your claim is a claim on the trust, settled in cash. None of these structures is inherently good or bad. People use all three for different reasons, and for most of the time the distinction barely matters because the system isn't under stress. But in January, when that physical delivery crunch hit, the distinction mattered quite a lot to people who needed to know exactly what their paper actually entitled them to. If you don't already know, with certainty, which of these you own, that is genuinely worth 5 minutes of your weekend to confirm. Not because something is guaranteed to happen, just because knowing what you actually hold is the kind of basic homework that pays off disproportionately the one time it matters. So now we've covered your entry price, and we've covered what you actually own. But here's the part that I think is the most underrated piece of this entire puzzle, and it's something almost no one checking the silver price this weekend is going to look at. Stop watching the spot price for a moment and consider 3 other numbers instead, because historically, these tend to move before the price does, not after. The first is that COMEX coverage ratio we already touched on, the one sitting in the low teens. Analysts who track this market closely generally treat anything below around 15% as a stress signal, and anything approaching 10% as a much more serious warning that a repeat of January's dynamics could be building underneath the surface. This number is published by CME Group, and it's free to check. The second is the silver lease rate, the cost to borrow physical metal. Right now, lease rates have come back down to relatively calm levels, well below where they spiked in January. But if you see that number start drifting upward again, from low single digits toward 4, 5, 6%, that has historically been a sign that someone somewhere is scrambling for physical metal in a way that hasn't yet shown up in the futures price. Lease rates have a track record of moving before the headline price does, not after. The third is the gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold. As of this week, that ratio sits somewhere in the upper 60s, around 68 to 69 to 1. Earlier this year, during silver's run to its January peak, that ratio compressed dramatically, falling from the mid-80s down into the mid-50s in a matter of weeks, which is a historically unusual move, and reflected silver sharply outperforming gold. Since the correction, the ratio has expanded back out, meaning silver has underperformed gold on the way down. Historically, sustained moves below 65 in this ratio have coincided with periods where silver begins catching back up to gold, while moves above 72 have tended to reflect periods where the paper market is punishing silver harder than gold. This is not a guarantee of anything. It's simply a relationship worth tracking, because it has tended to widen and compress in fairly recognizable cycles over the last several decades. But this is where the story becomes more interesting, because the explanation for why rates are even a headwind right now is not as settled as the headlines make it sound. The dominant narrative this week is that the Fed is hawkish, more rate hikes are coming, and that's simply bad for precious metals. But look at what's happening in the oil market at the same time. West Texas Intermediate crude has fallen sharply this year, dropping from levels above $100 a barrel back in the spring down to around $70 a barrel now, a decline of roughly a third. Oil is one of the most direct inputs into inflation. It feeds into transportation costs, manufacturing costs, plastics, shipping, almost everything. And inflation data tends to reflect energy prices with a lag of somewhere around 60 to 90 days, which means the inflation reports the Fed is currently using to justify a hawkish stance are still partly reflecting the higher oil prices from earlier in the year, before this drop fully worked its way through the data. That does not mean the Fed is about to reverse course next week. Chair Warsh has been clear that the committee's current bias leans toward further tightening, not easing, and 9 of 18 members are projecting at least one more hike. But it does mean that the rate path being priced into markets right now is built on data that is somewhat backward-looking, and the next couple of months of inflation reports could look meaningfully different if energy prices stay where they are. Some analysts believe that could eventually soften the hawkish narrative. Others believe persistent core inflation, separate from energy, could keep the Fed firm regardless. This is genuinely a live debate among economists, not a settled outcome, and it's worth watching rather than assuming either direction. Now let's talk about the level that actually matters on the chart, because this is the part that separates a normal correction from something more serious. For 13 years, from 2013 through most of 2025, silver simply could not sustain a move above $50 an ounce. Every time it approached that level, it failed and rolled back over. In late 2025, that finally changed. Silver broke decisively above $50, held there for months, and ultimately ran all the way to its January peak near $121. That breakout above $50 is widely viewed by chart analysts as the technical confirmation that something structurally different was happening in the silver market, tying together years of supply deficits, rising industrial demand, and shifting monetary conditions, which is why $50 now matters so much as a line in the sand. Silver sitting in the high 50s today is still comfortably above that level. A test of $50 wouldn't necessarily be alarming on its own. Plenty of healthy bull markets retest their breakout zones. But a sustained weekly close below $50, persisting over multiple weeks, would be a different kind of signal entirely, suggesting that the selling pressure in the paper market has genuinely overwhelmed the structural support underneath it. That is the level worth knowing, not because anyone can predict whether it will be tested, but because it gives you a clear, predefined point where the story would need to be reassessed rather than just endured. Now, here's the part of this conversation that nobody really wants to have, but it might be the most important one if you bought near the top. If your entry point was late 2025 or January 2026, somewhere in that $90 to $120 range, your math looks very different from someone who bought 2 years earlier. At today's prices, you could be looking at a real loss somewhere between 35 and 50%, depending on your exact entry. That is not a comfortable position, and I'm not going to pretend it is. But the question that actually matters isn't whether you're down. It's whether you can hold this position for the next 18 to 24 months without being forced to sell for reasons that have nothing to do with the thesis. If you have the liquidity, the time horizon, and genuinely the emotional bandwidth to sit through continued volatility while the structural picture plays out, then doing nothing and simply re-verifying your reasoning periodically is a defensible approach. Previous silver cycles, including the one after the 2011 peak, took years rather than months to fully resolve. But if you're in a position where you might need that money in the next 6 to 12 months, or if checking the price multiple times a day is genuinely affecting your sleep or your stress levels, that is worth being honest with yourself about. Reducing a position size to something you can actually sit with on your own terms, while you still have the choice to do so, is generally considered far healthier than being forced into a decision later by a liquidity need you didn't plan for. This isn't a statement about whether the long-term silver thesis is right or wrong. It's a statement about matching position size to your actual life circumstances, which is something good financial planning emphasizes regardless of the asset in question. So where does that leave you heading into the weekend? Markets reopen in Asia Sunday night, in Europe and the US shortly after. You have roughly 72 hours before the next full trading week begins, and frankly, that's plenty of time to do the handful of things that actually matter, without needing to refresh a price chart every hour. Know your actual entry price and your actual return, not your return against the January peak. Know precisely what you own, whether that's physical metal, an allocated trust like PSLV, or a cash-settled product like SLV, and understand what that ownership structure does and doesn't entitle you to. Keep half an eye on the COMEX coverage ratio and silver lease rates over the coming weeks, since both have historically tended to move before the price does. Keep the gold-silver ratio in view as a gauge of whether silver is catching up to or falling further behind gold. Hold $50 in your mind as the technical level that would actually change the picture, rather than every smaller daily move. And be honest with yourself about whether your position size matches your actual time horizon, adjusting it now, on your own terms, if it doesn't. None of this is a prediction about where silver goes next. Nobody, regardless of how confident they sound in a video or an article, can tell you with certainty whether silver tests $50, holds in the high 50s, or pushes back toward 70 in the months ahead. What the data does show fairly consistently is that the physical and paper markets for silver have been telling somewhat different stories in 2026, and that gap is worth paying attention to, regardless of which direction prices ultimately move. The investors who tend to come through periods like this with the least regret are rarely the ones who claim to have called the bottom. They're usually the ones who took a weekend like this one to actually understand what they own, why they own it, and what specific conditions would change their mind, rather than reacting to whatever the price happens to be doing on any single Friday afternoon. So here's what I'd genuinely like to know from you. When you look at your own silver position, or even if you're just watching from the outside, which number has more power over how you feel? Your actual entry price, or the all-time high you keep measuring yourself against? I think that single question reveals more about how any of us handle volatility than almost anything else in this conversation. There's also a bigger backdrop here that's easy to lose sight of when you're staring at a daily chart. The Silver Institute's most recent industry survey projects 2026 as the 6th consecutive year in which global silver consumption has outpaced mine production, with the gap for this year estimated at somewhere around 46 million ounces. That deficit doesn't resolve itself quickly because roughly 70% of the world's silver supply comes as a byproduct of mining other metals like copper, lead, and zinc, which means producers can't simply ramp up silver output just because the price moved. At the same time, demand from solar panel manufacturing, electric vehicle production, and broader electronics has continued growing on a multi-year basis, largely independent of what futures traders are doing on any given week. None of this guarantees a particular price outcome, and structural deficits have coexisted with falling prices before, sometimes for extended periods. But it's part of the reason some analysts continue to view the current pullback as a correction within a longer trend rather than a reversal of it, even as others remain genuinely uncertain. It's also worth remembering that central banks haven't been sitting on the sidelines this year either. Global central bank gold purchases came in at roughly 244 tons in the first quarter of 2026 alone, with China's central bank extending a buying streak that has now run for about 18 consecutive months. That's a gold dynamic more than a silver one, but it speaks to a broader theme that's shown up repeatedly in 2026. Official institutions and physical buyers behaving quite differently from short-term paper market participants. Whether that pattern continues, fades, or eventually pulls silver along with it is genuinely an open question, and I'd rather be upfront about that uncertainty than pretend anyone has a clean answer. Drop your thoughts in the comments, whether you're holding, watching, or skeptical of the whole thesis. I read through these, and the disagreements are usually more useful than the agreements. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions, so you can make your own decisions with your own money and your own risk in.